Hello students, let us understand about capital structure in this session. So basically capital structure is nothing but the structuring of your funds which you collected from different sources. So after accumulating funds from various sources like shares, debentures, retained earnings, so after that like how you are framing or taking proportions of different sources to put funds in your business is called as capital structure. It is nothing but the combination of all long-term sources of finance. Obviously, shares is a long-term source, debentures, bank loans, retained earnings, R&S. So all these different sources are actually long-term sources of funds. So it is combination. Capital structure is what the mixture of all the different sources of finance. It includes equity share capital, that is the owner's funds, and rest of the others are outsiders funds, that is preference, debentures, bank loans, all these things. So how you are accumulating from these different sources? Say for example, what proportion that you are taking from equity, preference, debentures, bank loans, retained earnings, that is what actually capital structure. So if you take debt as 70% and if you are taking equity as 30%, then that is the capital structure. Mixture of debt equity mix. It may be 50:50, 70:30, whatever ratio that you are taking from debt and from equity, and that combination is actually called as capital structure. So objectives of capital structure is like, the first one is to reduce the cost of capital, which is actually represented as K. What kind of cost of capital? See, cost of capital is again the minimum rate of return where you are expecting from the business that is supposed to return to your investors. At least the minimum return that you should earn from your source, from your business. So to reduce that cost of capital, see, cost should not be too high where that becomes a burden for you. If your cost of capital is, it keeps on increasing, it denotes that you cannot able to gain more profit which is supposed to return to your shareholders. And second is to minimize the risk. Yes, minimizing risk. See, equity should be high, debt should be less. That is the actual, we can say that is optimum capital structure. Always equity should be high and debt should be less. So where in that state, probably you cannot able to, you need not face any high risk over there. That is what minimizing the risk. Next is maximizing the return. Obviously, if risk is what minimized, the next thing will be your return. That return should be maximized. And last is control over organization. Entire complete control that you can take from your organization if your capital structure is optimum. Yes, I am having this much portion of debentures, this much percentage of equity, and for preference and for our retained. Entire thing that I am having in a proper manner, obviously you can have some complete control over there. And factors, yes, first one is utilization. Now you can utilize all the different funds. You can take it from equity, you can take it from preference, you can take it from loans. And growth and stability of sales will be there. Cost of capital is there. Nature and size of them depends on this also. It factors, certain factors influence and control, flexibility, requirement of investors, and last is conditions of the market. Based on the market condition also, this capital structure, it varies. So these are all the different factors of capital structure. Thank you.